Joining us now is Jonathan Golub, Chief U.S. Equity Strategist and Head of Quantitative Research at Credit Suisse. We haven't talked in a while, Jonathan. What's 2023? How are you feeling? What's your forecast?
You know, I think, Joe, there's just two stories. Over the near term, I think equity investors are going to be really excited about the fact that these inflation numbers are coming down, and they're going to be coming down pretty hard, especially on the good side. And this is going to actually empower the consumer. They're going to have their wages are going to remain sticky, but the things they buy are going to be coming down, or not coming down in price, but the growth rate in those will be lower, and they're going to feel really good. The problem is that if wages remain sticky, even if overall inflation comes down, the Fed is going to eventually have to come in and take that punch bowl away. So I think this is going to be a story of two halves, a much more healthy, vibrant half, which is what we're experiencing right now in the market, and a back half, which is going to be a little bit more difficult.
The revisions we've seen for earnings, Jonathan, enough? What's it going to be like? Have they been lowered enough to have a good earnings period in the next 3 weeks?
You know, Joe, these numbers are just collapsing. We have the earnings estimates for the fourth quarter are down something like 8 or 8.5% over the last 3 months, which is normally, you know, analysts overestimate how things are going to be. And right before earnings season, the numbers adjust down, and then you get a beat. There's a little bit of a pattern to this. We are way, way weaker than those numbers, and it's pretty broad based. A couple of areas are, I would say, most concerning or should really be in focus. But tech companies in particular are looking really, really sloppy. And I think that's going to be, that's what we've seen in the last few quarters. And I think it's going to last for a bit longer. There are certain areas that look a little bit stronger. Industrials look stronger. Energy looks a bit stronger. And if you want to be defensive, you know, utilities and REITs look a little bit stronger. But the trend is overall down. I'll just note one more thing on the earnings front. If you look at the expectations for the whole market, it's something like down 2.5% expected earnings growth for the fourth quarter. So the first negative quarter in a while. But the median company, so the typical company, is up pretty nicely, like 3% or something like that. So the majority of the names are going to have an okay earnings number, but the bigger cap names that dominate the index are going to be lousy.
What do you have for the S&P earnings?
So we have $215 of earnings, which is something in the ballpark of like a 4% negative growth rate on earnings, not for this quarter, but for 2023.
Where should multiples be, given what the Fed's involved with?
Well, the multiples, I think, actually do something strange, which is they actually rise a little bit, even though there's this weakness. So I think that the part of the story is that we avoid a recession, the credit, the bankruptcies and loan defaults and those things that typically happen when you're going into recession are probably not going to materialize. And that's going to push valuations up a little bit, but the earnings picture is going to be sloppy. I mean, if we look at last year, what we had was okay earnings and a collapse in multiples. I think this year we're going to have weak earnings, and the multiples are going to surprise everyone and be okay.
So we're right at fair.